Welcome back to the channel. Are your investing habits holding you back? Today I'm breaking down 6 common mistakes that keep people poor and how you can avoid them. I'll also share how much you should invest based on your income with actionable tips to get you on the right track. If you're serious about building wealth, then make sure you stick around until the end. We're talking about strategies that could change your financial future. Before we dive in, don't forget to like this video, subscribe for more market content, and hit the bell for updates. If you want access to my charts and trades, join the Patreon, which is the link pinned below. And as always, remember to use your own discretion when trading and investing decisions. Anyway, let's get started. The first habit keeping people poor is just not investing at least 10% of their income. And think about it. How can you afford not to invest? This is the S&P 500 right here. I guess there we go. That's the S&P 500. This is the last decade, okay? Example, if you put $10,000 into the S&P 500, which has historically returned an average of 6 to 10%, those are over 10-year periods. Any 10 years, there's some years it's up 30, some years it's not. We'll call it an average of 8%, which is very common for a lot of people when they're talking about this. That $10,000 could turn into $21,000 over a decade. That's the power of compounding. And a lot of things you hear people say a lot when it comes to this is you essentially double your money every 7 years. Now, I'm a full-time trader. This is where I make money, is day trading, in and out, all that, swing trading, and futures, options. I got some crypto. You won't see anything going on this chart. There's nothing to do here. All I said was you just put your money in this. Delete the app. Check it later. Okay? In investing also, it helps offset inflation, which erodes your money's value over time. Now, listen to this. The U.S. dollar has lost 99% of its purchasing power since 1924. Just let that sink in for a little bit. Your cash isn't as safe as you think if it's just sitting idle. If you're not putting at least 10% of your income into investments, you're falling behind financially. Now, this brings me to the second habit that keeps people stuck. Parking all your money in a high-yield savings account. Okay? Let's just take a peek at this. Leaving your money in a high-yield savings account in HYSA, it might sound safe, but it's actually one of the fastest ways to lose out on compounding purchasing power. Same example, you take that $10,000, put it into the high-yield savings account, earning 4% annually. Now it grows to about $12,000 in 5 years. However, if inflation averages 3% per year, your actual purchasing power barely moves, if not declines. As in, your $12,000 doesn't even buy you what the $10,000 did in the beginning. Come on. Now, let's talk about the mindset holding people back. Now, this one might be controversial, which is why we're full screen right now, but it needs to be said. Excuses like, I live paycheck to paycheck, or I can't afford to invest, they're all valid. I can understand that, but they shouldn't stop you from starting, okay? Start small. If 10% feels impossible, that's okay. Just start with 1% of your income, or even $10 per paycheck, whichever one's higher, okay? Doing something is the point. Then every 6 months, increase it by another 1% or $10. Small steps lead to big changes. Okay, cutting back on expenses like dining out or subscriptions. That can be the simplest thing that can free up enough to get you started. That's what matters, is starting. If you can't get yourself to do it, start writing down a dollar amount, same dollar amount, every pay period on a pad of paper. Just put $10, $10, and just keep a running total over there to the right. 6 months, check it out and see what that number is. Would you like to have that money or not? Because now look back on the previous 6 months. What did you actually spend it on? Okay? Could you have made some better choices or different choices to actually allow you to have that $10 per paycheck? Now, another huge mistake is not taking advantage of the 401k matches. If your employer has it, needs to happen. If your job has a 401 with a company match, you should be contributing enough to get the full match. It's essentially free money. Okay. For example, if your employer matches up to 5%, which is pretty common, that's 100% return on your contributions. Just straight out of the gate. Skipping the benefit of this is just leaving money on the table. I found this chart from Empower to help provide a better visual understanding just how critical this is. Because I want to show off this this exponential curve. Now, this is a salary of $65,000 a year. Company matches 100% up to 5%. Now, this is what you do if you just did 2% of your check, okay? You at retirement, you got about $433,000. Now, you put that 5% in, okay? Now, without the match, you're looking at $1 million. With the match, $1.6 million. Okay? Doing the same thing over and over again. Automating it, keeping it there, and what I really want to show off is actually this right here. This spooling up effect right here. This is what compounding interest looks like. Okay, everyone thinks it's just a straight steady ramp up. It's not. For you car guys, it's spooling like a turbo. Now, TikTok will have most of us looking no further than this tiny little portion right down here. You got to think bigger picture. And, man, when you're 65, you don't want to be looking back thinking, I wish I would have looked further. Now, let's talk about something more tangible, your spending habits. Let's keep this in the background for you guys. Again, the S&P 500. Everything I'm talking about that you're spending, you could just be putting right here in this. And I mean with zero knowledge of anything. You don't need to be buying new cars, expensive rims, or designer clothes. Fellas, if she's only into you for the way you dress, she's a lunatic. That advice is free. Now, it might feel great in the moment, but these are often liabilities, not assets. It means your money's not growing. They cost you money. Okay? There was a motivational speech that really changed things for me a long time ago. Because and I forget who it was. I really want to shout out his name, but he said the most your phone has ever brought you was a bill. You could use your phone, download a brokerage app, and use it to actually make money. You could be paying your phone bill with the money you make using your phone, turning a liability into an asset. Now, we know everyone knows everything about new cars, right? The average new car loses 20% of its value the second it leaves that dealership lot. So instead, redirect some of that into spending into investments. So even cutting back on the small expenses like the daily coffees, that they add up. Now, I've said it before, just buy the stupid coffee if you can afford it. Just the mental clarity or just the mental headspace. If it's going to put you in a better one, make it happen. But if money's tight, dial it back. You can afford to not have that coffee. What annoys me the most about the just don't buy your coffee, don't buy the $5, $8 coffee from Starbucks every morning speech is nobody ever finishes it. They never tell you what to do with that $8. You could save that $8 for the next 60 years, and you'll have enough to buy that new car now used later. That's about how long it would take. But anyway, this is actually why I started the growth account on Patreon. There is defensive versus offensive savings. Now, the growth account started at $0, has a weekly deposit of $150. Now, that was the average car payment at the time, monthly. When I started the growth account, every penny counted. I focused on safer plays to build a foundation, then moved into selling calls as the account grew. You can follow all these plays if you joined, or if you join the Patreon, like I've mentioned before. Now, there are two ways to save. I employed both of them. Again, defensive. This is the steady, consistent deposits, like the $150 I contribute every week into the Patreon growth account. This is what you'll often hear me call the just keep a steady drip coming in, like a faucet dripping. Now, later on, you'll learn about DRIP, which is dividend reinvestment. I'm not talking about that. Don't even confuse yourself with that. But just think a faucet that you don't want to freeze. Sometimes your dad would just turn it on; it would just drip overnight. You want to keep something coming in. Now, offensive savings. This is putting your money to work through the investments like stocks, options. There's ETFs. There's actually a boatload of ways of just doing things. Now, this last one, this one is detrimental. It's lifestyle creep once the money starts coming in. So lifestyle creep, meaning the more money you make, the more you might feel tempted to spend. And it even happened to me, and it can sabotage your financial goals. So instead of increasing your spending with every raise, commit to investing a larger portion of your income. And wealth is not about how much you make, it's about how much you keep and grow. And everyone, I know just a lot of people that have told me they can't wait to get this raise. and they already know everything they're going to do with it. None of it involves investing. It's you're going to get a dollar a raise, another $40 a week, and you're like, man, I'm gonna buy this or that. I can afford it. It's not like, man, I could just keep my lifestyle the same, invest that much more, and take a couple years off and retire that much sooner, because it compounds fast. But now that we've tackled the habits to avoid, let's talk about how to set up I don't want to say a balanced investment strategy and what that might look for in the long term. I don't know if I like the word balanced. I know it's a very, very calming thing to hear. You hear people say it all the time. There's a lot of ways to do this. There's a lot of ways to skin the cat, right? There's just 1,000,003 ways to do it wrong, and that's what's more important. So now, again, full-time day trader here. And I don't like saying day trader, but I trade. It's rare that's actually a day trade, more swing trading and stuff like that. But I kind of do, without giving financial advice. I would recommend just keeping at least 90% in stable options like the S&P 500. So SPY, VOO, it's the same thing. You'll often hear it's a cheaper one. Trust me, if you're watching this video, you're not worried about that financing fee. If you had $5 million, maybe VOO would be a more viable option. Worry about that then. It's a good problem to have. Now, again, not financial advice. Diversification can help balance the risk to reward, which is why I say 90%, because a lot of people, I found when they do jump into this is from personal experience, they just aren't happy with putting their money there. Now, they have no problem putting their money in a savings account and letting it sit there. But they do not want to put their money in the S&P 500 and let it sit there. They think they're in stocks. They're a super investor now. They got to do something. If you want to jack around, whatever. Okay, 90% in SPY, 10% with whatever Facebook advice you just heard. Right? Your wife's boyfriend's got a hot tip on the next meme coin. Whatever. Okay, you can't really hurt yourself with a garden shovel. Okay, you got the big money doing the work. Okay, it will smooth over a lot of what you're doing, because there's just a good chance you pick the wrong stuff. This is from me that I do for a living. Explaining to somebody that has no idea what they're talking about. You just don't know what you don't know. That does not get talked about enough online. But it's if you want to jack around, keep it in small numbers. It's something you've heard on a lot of my streams. If you haven't been here before, you cannot lose your butt unless you put it on the line in the first place. Put yourself in a position to not ever be able to lose. I could take 100% loss on any one of my trades, and I am 1,000% fine. It doesn't worry me in the slightest, okay? Anyway, what other questions you guys have about investing? If you did enjoy this breakdown, just don't forget to like, subscribe, and hit the bell for more market insights. Again, if you want access to the charts and trading community, join the Patreon link pinned below. Which is where you can follow and watch the growth count plays and check out the pinned video where I pointed out which industries I think will perform best under Trump. It's a must watch if you have investing questions. Anyway, thanks for watching, and I will see you guys in the next one.